I've spoken to a number of MBA classes over the past several years, and I have to tell you, I always enjoy it. I always look forward to it. To me, it's always engaging, and hopefully this will be engaging here this afternoon as well. But I have to tell you, I've never spoken to an MBA class in a country where the economy is really transforming itself so quickly. In fact, I'd say it's a remarkable transformation. The way I see it, an education is really one of the great drivers of Russian economic growth, and that's why I'm excited about being here this afternoon. Russia has always, as you know, taken education very seriously. In fact, interesting statistic, more than 2/3 of Russian students study beyond high school, which is a larger percentage than the European Union, which is pretty remarkable. I think the value of the MBA degree will increase as Russia really moves towards a market economy, because the need for business leaders will only grow into the future. So today, the first thing I'd like to do is really focus on the global economy for a couple minutes, and focus on the economy that will emerge once the recession is over. I'd like to discuss some of the changes that you might expect, that you might see, and quite frankly, how some of these changes really might impact your career. Then I want to take a look at talent, the whole issue of talent, and take a look at it from two different perspectives. One is from your perspective as employees joining the workforce, and then from an employer standpoint, who are going to be hiring you. And then I'd like to wrap up with taking some questions from the floor. So let me begin with the economy. The global economy as we know it, and that you will enter as an MBA student, is radically different than the economy that I entered when I came out of school some 30 years ago. In fact, I would share with you the term global economy hadn't really been invented at this point. A handful of nations really dominated the economy, and most of the rest counted on exporting goods to those countries. But now, with both labor and capital more mobile than ever before, and with communication truly instantaneous from really any 2 points in the globe, economies are really strongly connected. And that can really be beneficial. And quite frankly, when you think about it, it can be really harmful, which is what we're seeing today as a result of the global recession that we're all dealing with. We all know the global economy is really struggling with the worst recession we've seen since the 1930s. And to put all this into perspective, let me share some data from the recent World Economic Outlook, which was published in April by the International Monetary Fund, which I think is pretty interesting. The global economic activity is projected to contract, that's right, contract, by 1.3% this year, in 2009, and to improve only gradually in 2010, to growth just over 1%. Total estimated write-downs on global exposures are at $4 trillion, most of it covered by exposure to assets which originated in the United States. The wide-ranging policy responses intended to stabilize each of our economies has largely failed, have not been responsive to the environment that we're dealing with. Overall credit, private sector, in the advanced economies is expected to not only decline this year, but equally important, decline next year. And forward-looking indicators are down for both emerging and advanced economies. Now, the IMF snapshot is not a pretty picture, as we all know. But I'm glad to say that at least in the near term, we've begun to see some positive developments, some more optimistic signs of what could come in the next 12 to 18 months. After a spectacular collapse, we're now beginning to see some stabilization in world trade. The flight from emerging markets, including China, India, Brazil, and Russia, has started to reverse itself, and that's encouraging. 3 weeks ago, the president of the European Central Bank, speaking on behalf of the world's leading bankers, and not just Europe's, said he saw, and I quote, a slowing down in the decrease of GDP. Some economies are actually seeing an impact. Global liquidity is actually recovering, which is, again, a positive sign. And there are recent signs of a recovery in the stock markets. In fact, as you know, Russia's stocks have returned to all-time highs in the most recent weeks. So that's all good news. But if we take a look at some of the other news, we really have to question whether or not this will be the foundation for a long-standing recovery in our global economy. But when it does come, the question is, what will this recovery look like? How will the world really differ from the world we knew 18 months ago or that we know today? Well, one major fundamental difference I believe will occur is that we will see a real return to business fundamentals. The global financial crisis has shattered the confidence of CFOs, CEOs, causing them to never before focus on the likes of credit, liquidity, revenue, and cost. Again, getting back to basic fundamentals. They will continue to monitor business activities very differently than they have in the past. And quite frankly, their boards of directors are going to be much more diligent than they were in the past as well. Capital will most likely be more expensive. Companies will favor liquidity and aggressively manage its risks as well as deal with its internal controls. Going way beyond payables and receivables, financial executives will examine their operations in new ways to focus on cash flows and liquidity. Interestingly, in one survey, 70% of executives responding that they are examining the physical supply chain to see how they may be impacting cash flow as well as working capital requirements. A second key difference in the post-recession world will be regulation. In fact, the bottom line, you can expect to see much more regulation. While national characteristics will still have an economic impact, regulators and standard setters will collaborate in ways that we have never seen before across borders. At the G20 meeting in April, they came out with a very strong pro-regulation statement, citing the need to establish much greater consistency and systemic cooperation between countries in a global financial system. In fact, the G20's new Financial Stability Board has a very strong mandate, including implementing tough new principles on pay and compensation, taking action against non-cooperative jurisdictions, principally focused on tax havens, and extending regulatory oversight and registration to credit rating agencies. Now, while each of these is controversial, what is not controversial is the difficulty in designing an international regulatory structure that will facilitate trade and reduce systemic risk, and yet not stifle the entrepreneurial activities in the various nations affected. As a result, a key challenge that has to be dealt with. The bottom line each country is going to deal with is where to draw the regulatory lines that will be a key activity in the post-recessionary world.